Good afternoon, or possibly good morning, depending on where you're listening to us today. I will welcome you to our webinar this Tuesday, Everything You Need to Know to Invest in Real Estate with Your IRA Account. So both myself, Scott Maurer, and my colleague Larissa Greene are going to take you through a lot of the general information that if you're considering investing in real estate with an IRA account, what you need to know to get started, and also go over some case studies and give you some examples of real estate investments that people have made with their IRA account and what that process looks like as well. As I mentioned, my name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company since early 2006 and spent most of my time initially helping people through these types of transactions we're going to talk about today and how those investments get made and what that process looks like. I've spent the last several years, though, focusing more on the educational component of our company and letting people know how to self-direct an IRA and what that means. Like I said, I'm joined by my colleague Larissa Greene. I'll let her introduce herself.
Hi Scott, how are you doing today?
Very good.
Good. Yes, my name is Larissa. I'm with Advanta. I've been with Advanta since 2011, so I'm getting close to 9 years here, and I do business development and education. And I actually started doing back office work just as Scott did. I am very familiar with check coding, new accounts, transfers, and then of course teaching classes. So that's really where I spend most of my time these days, and I really, really enjoy it. And of course, networking with people like you attending our webinar today. And we have some more opportunities to learn and network coming up that we'll talk about shortly. Thanks, Scott.
Yeah, thanks, Larissa. Yeah, so anyone who's listening live today, you're lucky because you have two people who've been with the company probably the longest in this type of role of educating the public and again teaching classes and sharing that information. So one thing I would ask, if you are listening live today, there is a question box on your GoToWebinar dashboard. If you have any questions for myself or Larissa on the things we're discussing, or maybe something that's a little ancillary to that, please write those questions in the question box or type them in, and we'll make sure we get to those and get those questions answered. This webinar is being recorded, so if anyone's listening to the recorded version, here is obviously hopefully jot down my information, Larissa's information as well, and you can certainly reach out to us with any questions that you have. Just a quick disclaimer, our Advanta IRA, nor any of its employees, we do not provide investment advice or endorse any products. So a lot of times we do have guest speakers on our webinars, and we're not endorsing particularly the investment that they might be associated with. And that's just something we don't do at Advanta. We don't provide investment advice. We don't endorse any particular products or investments. The material we present is always for educational purposes. We want to expose people to new ideas and new things, but ultimately it's up to you to do your due diligence on an investment. And also, if you have any tax or legal considerations, to consult with an attorney or an accountant before entering any type of an investment. We can certainly provide you with referrals to attorneys, to CPAs, or anyone else that you might need to help you to make that decision. Just a little bit about our company. We've been around for almost 20 years in the industry, and the only thing we do is administer self-directed IRA accounts. We don't provide any other service than that administrative work. We have over $1.3 billion in assets under management. We have two offices, one in the Tampa Bay area, which is our home office, and also one in Atlanta. But we do work with clients all across the country and really separate ourselves really in two ways: the educational offerings that we present, like what you're attending today, and also through our personal concierge style customer service experience, where each new client is assigned to one account manager to help them with anything they need regarding their account. So really that's how we try to set ourselves apart, and hopefully you'll get a lot out of today's presentation.
So what is a self-directed IRA? We're going to start here with the definition because a lot of people just simply haven't heard of truly self-directed retirement accounts. And so part of our job at Advanta is just to get the word out. So we market through education, because if you don't know about how that these accounts even exist, you won't know how they work. And so that's very important to us, that people not only know about them, but understand them. And so what is a self-directed retirement account? Well, the first thing is it's going to give you control over your account, complete control. So we don't sell any investments at all. What we do instead is hold the account and help you get it invested in what you know best. So that's a huge advantage to having a self-directed retirement account, is you investing in what you know, maybe what you love, and understanding the return that's going to go back to your retirement account. And Charles Schwab, Fidelity, Morgan Stanley, those are all really great companies. but what we do is going to be a little bit different. And so we're really not competing with brokerage firms. What we're doing instead is filling the gap in the industry to hold those private assets that those brokerage firms will not hold. And they have a fiduciary responsibility. They don't want to be responsible for those assets that they consider hard to value. They're not set up to receive income, maybe rental income or mortgage payments to an IRA, or maybe even pay a mortgage on behalf of an IRA. And so that's where we come in, and that's what a self-directed IRA is really all about. We'll give you some examples of those types of investments that we see on a regular basis, but the idea being that these investments are not publicly traded. And so I sort of already mentioned what it is that we do, and really just the reason that you haven't heard about them is because there's not a lot of companies out there like Advanta doing what we do. And so an account that holds market-based investments is going to be much more common than a self-directed IRA administrator custodian holding those assets that are outside of the market. And so the IRS regulations actually allow a very broad range of investments. And so if you go to the IRS website, instead of finding a list of investments that you can make, what you're going to find instead is a list of the only two asset classes they don't allow. So that's just very simply life insurance and collectibles, and we'll talk about that shortly. But the idea being that the sky is just about the limit when it comes to self-directed accounts. And you can see down here on my slide that less than 4%, and we put IRA investments, but it's actually all retirement accounts are truly self-directed. So they're holding those private assets that we're going to talk about. I always like to go over the different types of self-directed accounts or plans that are allowed to be self-directed. And the reason for that is oftentimes people will say to me, well, I don't have a Roth IRA, so I can't buy real estate. Scott, do you encounter that a lot?
I do, and that's people get confused that a self-directed IRA is only one specific type of IRA as opposed to all the different options you see on this screen.
Yeah, and I'm really not sure where that comes from. And of course, the concern there is that if it's a Roth IRA that's the one that can be self-directed, of course, a lot of times people don't want to incur the expense of converting over to a Roth, because a Roth, of course, is an after-tax account, and so therefore there's going to be some tax liabilities to you if you go from a pre-tax to an after-tax account. But the truth is that if it ends in IRA, it can be self-directed. So we have, of course, up here the most common types of accounts, traditional and Roth IRAs, but then also small business IRAs, simple SEPs, and solo 401ks. Those can be self-directed, as well as any former employer plan. And the reason there's emphasis there on former is that a lot of times if you're currently employed and you're participating in your employer's plan, they may not allow you to move those funds. And it's always worth checking, but usually there's going to be something involved like your age, so you have to be 59 and a half before you can do it, or you have a certain amount vested before they'll allow you to do it. So there's some things that come into play there, but you can always check. And of course, there's always exceptions to the rules. We also have listed up here health savings accounts as well as education savings accounts. And the reason they're listed here is just very simply the rule for self-directing these types of accounts is exactly the same, or they're exactly the same as IRAs. And so we can help you with those as well. And we're definitely seeing more people interested in health savings accounts that, they have a lot of benefits to them. And we actually have a webinar just based on health savings accounts, how they work and how you can self-direct them. So if that's something you're thinking about, just definitely check out our webinar database, and you will find our partner Alex has done a great job on explaining how health savings accounts work.
Yeah, and as before we go to this next slide, a great question pops up here on our participants here. One of them says, "Can you use self-directed accounts to fund a charitable contribution?" And the answer is yes, you can. It's a situation you definitely want to talk with a tax advisor to make sure that you're structuring it properly. But you can take a distribution from a self-directed account, just as you could really any IRA account, and use that distribution to fund a charitable contribution. There's different tax ramifications that go along with that. But again, one of the things that's, I guess, important to note about that particular question as well is, again, a self-directed account. Self-directed, again, as Larissa was explaining, referring to the ability of you to invest in different types of assets. But at their core, An IRA account is, again, either a traditional, a Roth, maybe a SEP or a simple. And so the self-directed accounts follow those exact same rules for distributions, contributions, and certainly funding a charitable distribution as well. One question we get a lot from individuals, or we've seen, I'm sure Larissa can answer and agree with me on these as well, is why people choose to self-direct. Why are people looking to buy real estate in an IRA account? What's the motivation behind what they're looking to do? And for a lot of people who are looking to use their IRA to put it to use in real estate, for many of the investors, the IRA is simply a different source of capital that they have to buy their next rental property, to buy into a multifamily syndications. We're going to go through some of those case studies in just a minute. But the cash from the IRA simply provides that client with another bag of money to use for an investment. So they may have already tapped into a home equity line, or maybe they've gone to the bank before to get a mortgage to buy a rental or investment property. And simply the IRA provides them with just another place of money to use to make that particular investment. For some clients, there's tax benefits. It is a motivating factor of self-directing if the income that your IRA generates is not taxable to you. So as that income is generated, as the investment returns come back in with the rents and the profits, that comes back to your IRA either tax deferred or possibly tax-free when we're talking about a Roth IRA. So someone who's looking at making an investment with a great return to come back, they don't necessarily want that now on a personal basis, because that could be a situation in which they are, in a higher tax bracket now. They'd rather have this money continue to grow tax deferred. For others, and this is, again, one of the things that with these three reasons, a lot of people fit into all three of these buckets, but there's still that stock market fatigue. Right now, we're seeing the stock market hit highs, as high as it's almost ever been. A lot of people get a little skeptical of that and are worried about what that means as far as the next few months, next year or two, and are tired of riding the market up and down. We saw back just 4 or 5 months ago, the market take a huge dive and then just rebounded right back. And we're not sure when that next dive or the next rebound is going to happen. And for those individuals looking to get some of their money out of that market, off of that roller coaster, and into something they can control, like real estate. And as we're going to talk about real estate today, again, one of the things, and Larissa, do you have people that tell you, like, I invest in real estate, but you want to be a little more specific maybe about what they're talking about?
Yeah, exactly. So, especially when people say to me, well, I use my IRA to invest in real estate all the time. And so, but what they're doing is taking distributions. So it's
Yeah.
much different.
Yeah. So again, when someone says, "Hey, I heard I could use my IRA to buy real estate," I have to ask the question. I go, "What are you looking for in real estate?" Because the term real estate could mean anything from buying rental homes, commercial real estate, rehab projects, multifamily syndications, raw land, investing in notes and mortgages, lending money to somebody else on a piece secured by a piece of real estate, tax liens, joint ventures. The list really does go on and on. So as Larissa mentioned earlier, we'll clarify here again in a moment. There's only a few things that you can't do within an IRA account as far as making investments. So, but when it comes to real estate, really, again, as Larissa said, anything is going to be possible, just as long as you make sure you stay within the rules of what you can and can't use it for.
And that's a great point, and sort of addressing a question that popped up here about using a mortgage from a bank in order to purchase real estate. And we're really not going to go into that during this webinar, but I do want to quickly address it because, as you can see, there's all different strategies you can use with a self-directed IRA. And as a matter of fact, using a mortgage to purchase property in an IRA is also possible. So that's a great question. There are a lot of moving parts when you use a mortgage, and so reach out to us and we can talk one-on-one about that strategy and the possible tax implications there. And I think we do touch on that very briefly during the webinar, but it's important to understand how that works more specifically. So if you have questions on that, please reach out to us so that we can go over that with you, so you can understand how that works.
Yeah, and again, one of the common questions we get, especially from people who are just looking to get started with a self-directed IRA, is really, how do I get the money moved from that brokerage account, or that bank account that I have my IRA currently held in, to a self-directed account? And it's usually either done by either transfer or rollover. And a transfer is simply moving money directly from one IRA at one firm to an IRA account at, say, an Advanta to put in that self-directed account. A rollover is typically when you move money from an employer-sponsored plan, like that former 401k that Larissa mentioned a little while ago. Moving that money from an old 401k or maybe an old 403b plan over into an IRA. The great thing though about transfers and rollovers is that as long as the money doesn't touch your hands, it's a non-taxable, non-reportable event to get that money moved over into a self-directed IRA, and then in turn use that money towards your next real estate investment. We will walk you through that process. If it's whether it's a transfer or rollover, let you know the paperwork that's going to be needed, and even submit some of that paperwork on your behalf to get the funds rolled over and transferred. It's a non-taxable event to move money between different accounts, and it does not have to be the entire account. You can do partial transfers, partial rollovers. You could even transfer money back out of Advanta to your brokerage firm or bank if you choose to, if you have some cash built up inside your account. So again, you have a lot of options when you're moving the money, and we'll walk you through every step of that way.
Absolutely. And we had another question pop up, actually really regarding the last slide about types of investments and can you do Forex trading? And the answer is yes, you can absolutely do foreign currency trading in a retirement account. You can choose the platform that you want to use to do trading, and then you just let us know. We help you get it done. Your trading account is actually opened in the name of the self-directed retirement account, and then you're all set to do your trading. So that's absolutely something that you can do in a retirement account. And so now we're going to talk a little bit about the rules and sort of how that works, what you can and can't do, and also who you can and can't transact with. And that's very important. And that's a big reason that we like to talk about the rules, because understanding them, even on the higher level, just an introductory of understanding how these rules work is going to be important to you, so that you can, when you're looking for those investments, you can kind of qualify them yourself, and then of course bring them to us and ask the questions, hey, will this work in my self-directed retirement account? We're happy to answer those questions. But again, the two types of investments that are not allowed in a self-directed IRA and actually listed on the IRS website are going to be life insurance and collectibles. And so things like antiques, of course, and alcohol, artwork, stamps, and some coins are not going to be allowed in a self-directed IRA or 401k. And it's just important to know that, of course, there are gold and silver coins and bars allowed, and some other coins as well, as long as they're valued based on what those metals are trading at. But if the value is based on them being rare or collectible, then that is something you're not going to be allowed to do in a retirement account. Some prohibited transactions are going to be basically you transacting or your IRA transacting with disqualified persons. And so we'll talk about disqualified persons on the next slide, I believe, but it's important to know who would be considered disqualified and who could potentially be disqualified as well, so that you're not transacting with those people. And I don't think we talk about it really in this webinar, but it is possible maybe to partner with some of those individuals, but you do want to understand the difference. And then we also have up here knowing about unrelated business income tax or unrelated debt finance income tax and when those may apply. And it's very rare that you're going to see a tax apply to a retirement account while investments are being made. Of course, if you take a distribution and you had a pre-tax account, you're going to have the tax show up as ordinary income the year you distribute any amount. But typically when you're making investments and those are considered passive, you're not going to have any tax burden to your IRA. But there's two instances where there are taxes that apply. One is going to be, of course, when you're buying property in an IRA and you're using leverage. So again, remember I talked about those moving parts. This is going to be one of those times where taxes do apply. It is a tax burden to the IRA, not to you, but you should be aware of how that works if you're considering leverage. Another time is when you have business activity in a retirement account. So again, most of the time, your investments are going to be considered passive and there's not going to be a tax burden that applies to the retirement account, but business activity would be one of those times. And sometimes it's really hard to sort of figure out whether or not something would be considered business activity, but typically you're going to have, mortgage payments are going to be considered passive, rental income would be considered passive. But if you're investing into a company and you're you're holding private stock, for example, you have dividends going back to the IRA, that's going to be considered passive. But if your IRA has a more substantial portion of that business and you're receiving business income rather than just simply passive dividends, that is going to be an instance where you want to get your CPA involved and understand how the tax may apply in that case. So here are the disqualified persons when it comes to your IRA account. And so you can see in our nice chart here that it's going to be up and down your lineal tree. So it's going to start with the IRA holder and spouse of the IRA holder, and then parents and grandparents, children, grandchildren, and then any business spouses or business entities of those. And we have some examples to really help you understand this, but you want to be aware that you can't transact, buy, sell, goods or services, trade, anything like that with any of these people that are considered disqualified to the IRA. And basically, sort of understanding the purpose behind this is the IRS says that there can't be any current benefit to the IRA holder for the transaction in the retirement account. And so sometimes people will say to us, well, you know, I know that I can't hire my son to do work, but what if I pay him fair market value, or what if I don't pay him? And really, it doesn't matter how you sort of structure it, it would still be considered prohibited. And so you can see here on this next slide, we have some great examples for you on what would be considered prohibited. So IRA purchases a piece of real estate from your son. Again, even if it was appraised and it was fair market value, it would still be considered prohibited. Sometimes people
Yeah,
will say
and
to
I
me,
was just
well,
saying, Larissa, that's a question somebody asked. That's a good point what you just said. Somebody asked, is it possible to purchase the property and rent it to a family member, someone who's disqualified, at fair market value rent? And as you just said, the fact that you're doing the transaction regardless of the terms, if your IRA is dealing with one of those individuals, it's going to be prohibited. So to answer that question, and like you said, you just said, it doesn't matter if it's fair market value or not with these investments.
Yep, and that's very important because a lot of times people will say, well, it's very easy to, you know, sell it or trade with somebody else, but you know, I would rather do it with a family member. We completely understand if it were our rules, we would change them, but they are not our rules, and we can't do anything to change the minds of the IRS, as you guys can understand. So it's important to follow the rules and make sure that you're making decisions that are going to help your IRA grow in what the IRS considers arm's length transactions. And you know, another question I get a lot about that is, well, what if it's in my son's LLC? I'm technically not transacting with him, it's with his LLC. Again, just keeping in mind on that prohibited, or excuse me, disqualified persons list, it includes business entities of those people that are considered disqualified. So that's very important. Again, leasing, buying, selling. You also have an example here of your father's IRA lending to you or your son. Again, that would be expressly prohibited. You know, this bottom example here, your IRA purchases real estate and hires your son or his company to perform the rehab work. It doesn't matter that your son might not be out at the property swinging the hammer. It could just be his company, and it still would be considered prohibited. That would be a current benefit to you, and it would be involving a disqualified person or their business. This one is interesting. Your IRA makes a down payment for a property and you personally guarantee the mortgage. So we already talked about how you can use financing to purchase property in an IRA. That is possible. What you can't do is extend your personal credit or give a personal guarantee. So it would be important that the loan is considered non-recourse. And I know what you guys are thinking. Where does that even exist? And it actually does exist. There are national lenders that have made it their business to lend to IRAs in a non-recourse fashion. So it's possible to get the loan out there, but you can't extend your personal credit or give a personal guarantee. So very important, the loan is to your IRA and not to you. So the IRA is going to make the payments. And typically what you'll find is they'll want a larger percentage down. Usually it'll cost you maybe a point or so higher than fair market value for these types of loans. And what I have seen, what clients have reported back to me when they're doing these types of loans, is that the lender is going to do a market analysis for the rent, and that's how they determine how much they're willing to lend and what the interest rate will be. So very interesting, and definitely a strategy we see people use.
Hey, Larissa, before we go forward, we got a number of questions that have come in kind of as we're talking about prohibited transactions. Maybe a good idea to take some of those. So if you want, I can ask some of the questions and we can both answer them here.
Sure.
Someone was asking, well, number one, someone said siblings are not prohibited, which yeah, you're kind of a question mark, maybe a surprise from the question asker is yeah, siblings are not considered disqualified persons. You would still want to make sure you're dealing with them on a fair market basis. That's when fair market value would kind of come into play when you're dealing with family members who are outside of the individuals we showed on that slide. But yeah, siblings are not prohibited. Um, Also, someone asked if our son forms a multifamily syndication, can we invest in it? And the answer really is if your son is going to be one of the general partners of a syndication and be receiving compensation for that role, then your IRA technically should not invest in that syndication because now it could be looked at your IRA as, in a sense, paying him for his services. So, kind of in a roundabout way, we would definitely discourage that type of an investment as well. Larissa, here's one for you. Can you loan money to someone unrelated to you, but indirectly for your own benefit? For example, if I lent money from my IRA to the contractor that is building the house, what would you say about that?
So really, I mean, you almost define the rules in the question. There is a current benefit to you in that example, and so it would be prohibited. So remember, I mentioned when I talked about how the rules work that there's disqualified persons, and then there's the potential for people to become disqualified. And this is going to be that scenario where that third party really has become disqualified because there's a current benefit to you. I always like the example. I actually talked to a gentleman who wanted to buy a condo and put it in a rental pool with his IRA. So, he's buying the condo from a third party. He's not managing it and he's not renting it to anybody related to him. So, on the surface of this transaction, it would be okay. But the condo also came with a boat slip and he was going to park his boat there. And so I explained to him that this is a current benefit to you and also personal use for you. And so that would be prohibited. So on the surface, the transaction doesn't sound prohibited, but then when you add the personal benefit to it, now it's become prohibited and something you cannot do with IRA funds.
Yeah, and that's yeah, perfect answer. And I think kind of what you're relating to what you just said. Another individual asked, "Can I buy a vacation rental in another country and then stay in that vacation rental for a few weeks a year?"
Right, exactly right. And so I think there are some rules when you're personally investing, when you're using personal funds. You can still qualify it as an investment and still use it, at 1 or 2 weeks a year. But with an IRA, that is not the case. An IRA, it can't be rented to third parties 50 weeks a year, and then week 51 and 52 are not for you as the IRA holder. Non-disqualified third parties, as the IRS calls them. And so, unfortunately, there's no allowance for you to use the property at all.
Yeah, and then last question. Well, maybe we'll get back into the slides. I'm gonna add to what if after retirement, am I able to move into a property that was held in the IRA account? And the answer to that question is potentially. But in order to live in the property, and this would go for whether you wanted to use it for a few weeks or use it exclusively and move into it, the property can no longer be inside the IRA account. So if you got to retirement and decided that you wanted to live in the property that you hold inside your IRA account, you would have to distribute that property at that current value to yourself and actually take a distribution. So depending on the type of IRA you have, it could be a very substantial tax bill to simply distribute all of a property to yourself. But it's definitely something that might be possible. But you'd want to talk with a tax advisor before simply distributing that property out to yourself once you reach retirement. So again, just more great questions coming in, so keep them coming. Larissa, I'll let you resume the slide presentation.
Okay, I just have one more example here. On the last box, we have spouse's IRA owns a piece of real estate and wants to sell your IRA a portion of that property. And again, you are considered disqualified from transacting with your spouse and your spouse's IRA, of course. And so, unfortunately, once the ink is on the paper, it doesn't even have to be dry. If you've closed on a property, you can't include your spouse or your spouse's IRA. However, remember how I mentioned that it is possible to partner even with disqualified individuals and entities. So it is something that you could have partnered with at the outset. So if I had my IRA and my husband's IRA, and we both have $100,000 in our IRA accounts, we could buy a property at 150,000. we could own it 50-50. The percentage of ownership is just simply going to be based on the amount each IRA brings to the table for closing. And then based on that percentage, we have now established ownership. The percentage has to remain the same throughout the life of the investment. So that's very important when you're talking about disqualified individuals. However, it is something that we see people do all the time, and it is very easy, and we handle the accounting for those separate IRAs. And so we would say, okay, they've determined they're going to own it 50-50. We'll take 50% out of each at closing. And then anytime there's an expense, we'll pay it 50-50. And anytime income is received, it will be divided 50-50 among the accounts. And again, 50% just being my example, but it could be 80-20. And we've even seen some odd percentages like 5% and 95%, just depending on what the deal will require in order to make the investment. So we're talking very specifically about real estate today, and we always like to give you an idea of the investments that we see on a regular basis. And so this is very normal, everyday stuff for Advanta, and I know you guys are new to it. And so we like to kind of give you an idea, then also invite you to ask more questions about the investment types and how they work. But single family homes are going to be very common. We're doing closings for those all the time. And basically, again, this is your opportunity to invest in what you know best. And so if you typically would invest in a 3-2 or a 2-1, whatever it might be, you can do that with your retirement account. And it can be a long-term rental, a short-term rental. You can do rehab projects. Any of those things can be done with retirement funds. We see people invest in condos and mobile homes and mobile home parks. And as well as through syndications, as Scott mentioned, we see tax deeds and we see tax liens as well. We mentioned that at the beginning. Real estate investment trusts, and I know some of those are publicly traded, but a good number of them are also privately held, and that is something we can help you with. And then again, syndications or private placements in commercial property, multifamily property, anything of that nature can be held in a retirement account.
All right, so go over some of the ins and outs of buying real estate and maintaining, hopefully give a little more color and flavor to what we talked about as far as some of the rules of what's involved. Very quickly, had another question just come in, say, my brother and I own a real estate company. Can we use a self-directed IRA to purchase properties in the name of the self-directed account as long as we have professional property management and do not take draws or profits on the property? And the funds would all be directed back to the IRAs at time of sale. That's correct. That is acceptable to do, again, as long as you and your brother are partnering your IRAs or say an IRA and somebody's individual money on that deal and not buying the property through the company that you split. If you just did it as a separate deal, maybe a separate entity, you can do that. And as we're going to talk about here, all the income that's generated will flow back into the IRA account. So if you're looking to buy real estate, it's important to know, this is something that we're going to help you out every step of the way. But when the property is purchased, when you're using an IRA fund, the property is actually purchased in the name of the IRA account itself. So if John Smith was buying a property using his IRA, he's not going to buy that simply in his personal name. If he were to do that, the IRS is going to deem that to be a taxable event that he pulled money out of his IRA to buy something on a personal basis. So instead, the property is actually going to be purchased directly in the name of the IRA. And you can see on this slide an example of some of that wording: Advanta IRA for benefit of John Smith's IRA, followed by his account number. And in a lot of situations, the funds from the purchases come from the IRA themselves. All of the funds, it's a 100% deal, one person using just their own IRA account. But as Larissa mentioned a minute ago, you can partner with other people, including your own personal funds. As I just talked about, you can partner with a brother or a sibling as well. And again, all of the income goes back into the IRA tax-free. So the rents that you receive on a monthly basis, the profits on the sale, that's all going to return back into your IRA when your IRA owns a piece of real estate. If your IRA owns a percentage, your IRA is going to receive that percentage back to the account as well. Paying bills and expenses. So as the income that's generated from the property flows back into the IRA, all of the expenses related to that property also needs to be paid by the IRA account as well. Now, if you're using Advanta IRA as your administrator to hold the property directly, you can simply submit a copy of the invoice to us to get that bill paid. We typically pay a bill either same day or by the following business day to get that expense paid out. You also have the option to use a property manager, is one of the questions that came in asked, or you have a property manager, someone who's a third party collecting rents, paying bills, and then forwarding the excess cash or the net profit basically each month back to your IRA account as well. So it's really up to you on the role you want to take. If you want to be responsible for making sure your tenant is sending the rent check and hiring your contractors and having us pay the bill, or if you want to outsource that to a property manager. Now, when it comes to actually managing the property, again, when it comes to repairs and maintenance, so cutting the grass, repairing the roof, painting the inside, the IRA owner nor disqualified person should not perform any of those services on the property. So it's a key to, we went back to those prohibited transaction rules that the IRA owner cannot give anything of value or benefit in that case to the IRA itself. So if you need something to be repaired on the property, neither yourself nor a disqualified person should do that work. Certainly, who can do the work? Anybody who's not disqualified. We already talked about siblings as being one of those individuals, but certainly any third-party company. It doesn't have to be necessarily a licensed or bonded company. If you don't want to work with, somebody else, that's not a barrier. But the IRA owner can inspect the work. So the IRA owner, if it's your account, it's your property, you're choosing who's going to do the work, making sure the work is done properly, but just making sure that the IRA is actually paying for the work that's being done directly. And again, renting the property, if you'd like, you can, if you're not using a property manager, the IRA owner can select and qualify any tenants. We will sign any lease on behalf of the IRA accounts, and then the rents will come back in and be deposited into your IRA account. It is up to you as the owner and your IRA account to negotiate the terms of the lease, how much per month, notices, what the term, what the length of the lease might be. And the IRA owner typically is named as the contact for any issues that tenant has. So the tenant's still going to be reaching out to you possibly with questions again, unless maybe you're using a property manager who can handle those issues and run some interference for you as far as the owner of the property. So you are involved when you buy real estate in your IRA account. You are certainly involved in either maybe selecting a property manager to handle those issues, or you're perhaps handling a lot of those issues yourself. It's just key again to remember that the rents need to come back into the IRA. And the expenses need to be paid out of the IRA. You do not want to be in personal possession of the rental income, and you cannot personally pay any bills. So again, this is something that we will help walk you through each step of that process.
And before we go on, there are some questions I wanted to quickly address. So one of them is, can we download the slides? Send us an email and we will make sure that you get the slides, or I think we can also include it in the thank you email that will go out. So maybe we'll do that, and that way everybody will get a copy of the slides. We are also being asked what are typical non-recourse loan interest rates, and you really would have to reach out to some of the companies that do it to find out, and that would give you the opportunity to shop it and find out what their process is. But we're typically told it's just a point or two higher than whatever fair market value is. And of course, I think it's going to also depend how much you're putting down and remember again, that rental analysis that they'll do, it'll probably really help them determine what they're willing to lend money at. And so that's probably all sort of factors of the non-recourse loan, and something you definitely want to reach out to the lenders to find out more about. I have another question here on taking partial ownership from the IRA to satisfy a required minimum distribution, and the answer is yes. You certainly can do that. I don't know that we've ever seen anybody do it. I can't think of anybody. Scott, do you remember ever seeing somebody do that?
I have not seen that.
So it is possible. So sometimes when you have real estate in your IRA, and of course you reach age what is now 72, and you're required to take a distribution from that account, if you choose not to or have no cash available, it is possible to have an appraisal done of that property and then take some percentage of ownership in order to satisfy that required minimum distribution. So yes, it is possible.
Yeah, and I was gonna add that, Larissa. Yeah, I definitely have had people ask about it, but the key thing to keep in mind whenever you're dealing with the required minimum distribution, is you can satisfy that distribution from any IRA that you have. You don't have to take a little bit from each one. So a lot of the people that I've talked to looked into taking some of the ownership out to satisfy that required distribution actually ended up taking their distribution from simply another IRA account with another firm that was much easier to do.
Absolutely. Another question I had is in the instance of partnering with personal funds, and Scott really sort of already addressed this, but just to come back to it quickly, can you pay the expenses and then get reimbursed from the IRA? The answer, unfortunately, is no. You want to make sure that the percentage of ownership is always the percentage that the bills are being paid, expenses are being paid at the outset. There is no reimbursement. If we take money from your IRA account and we give it to you, there is no other way to code that aside from distribution. So that's going to show as a distribution, which is not what you want. So that will not work, but you can certainly work with your IRA administrator, your account manager with Advanta in order to make sure those expenses are paid timely and based on percentage of ownership. And then we're only going to touch on it, but there's another option available to you in using something like an LLC, so an entity that will help you solve that, that puzzle as well. My son wholesales homes. Can I buy a property from him using self-directed IRA funds? Unfortunately, you cannot. I understand that he doesn't really have, he doesn't own the property, but he technically does have an interest in the property. And so that would be transacting with your son as the wholesaler. And so unfortunately, that would not be allowed. Another question pop up, can my self-directed IRA own more than one property? Absolutely. We have clients that are just moving over enough funds for one investment so that they can truly diversify their portfolio, and they find in a year that they really love the advantage of having real estate in their IRA accounts, and so they might move more money over to buy a second. But we also have clients who don't believe in the market at all and hold only real estate assets in their account, and so then in that case they have multiple properties or multiple mortgage loans. And so absolutely, the advantage to self-directing is going to be that your strategy really is your own. And the last question I want to address before I get to our case studies is, can non-US real estate be purchased in an IRA? And that's a great question. I actually did this webinar for a group of property managers yesterday where this came up, and absolutely, your IRA can certainly purchase property outside of the US. What's going to be important here is that we're not handling the legal aspect of it. So you do want to check in with those country requirements in order to make those purchases. So for example, if the country requires that you have an entity set up in that country in order to purchase the property, you'll want to know all of that before making the investment. And then you're going to come to us and tell us, okay, this is what I need to do, and I'm working with an attorney to get it done, and then we'll help you with it and get it done in the name of the IRA. But certainly we have clients that own things in Costa Rica and also in Sweden and a couple other countries over across the world. So absolutely, that's absolutely something you can do. Okay, and so I'm going to go on here to the case studies, and I really love the case studies because I think it really will help you understand what we're seeing and also what you would be doing when you go to make these investments. So starting with purchasing rental real estate. So this is going to be just a sort of run-of-the-mill transaction that we see at Advanta. Matt wants to use some 401k funds from a previous employer, and he wants to purchase real estate. The property is for sale for $120,000. So Matt's going to transfer over money and make the investment. So who does what? How does this work? Well, Matt first is going to open and fund his Advanta IRA account, and that's important because as you start this process, you're going to see typically what takes the very longest in the process is moving money from the existing account. So we're always sort of at the mercy of your current custodian to get the funds over to us. And so if you're thinking about doing this and you're starting to search for property, now is the time to get the account open so that when you're ready to put that earnest money deposit down, we have it available and we can do that on your behalf. So he's going to open and fund his account and again, find the investment property. He's going to make an offer to purchase. And at this point, it's going to be important to have the contract in the name of the IRA. And we have an example of that there. So when you're making offers, you're really sort of making them on behalf of what I like to consider your IRA, your business partner. So your business partner is your IRA, and so it's not a contract between you and the seller personally, but rather between your IRA and the seller. And so that's going to be very important. And here's where the advantage of having an account manager is going to come in, because you don't have to remember this. you just reach out to your account manager and say, hey, I know there was something special about the contract. What do I need to do? And then we're going to help you with that. So again, it's going to be in the name of the IRA. We're going to have Matt actually read and approve the contract. So he is going to sign it for us, but then we're going to sign on behalf of the IRA. So our signature is going to make the contract legal. And we're going to also have Matt submit purchase authorization forms letting us know who it is that he is working with in this transaction so that we can work with them as well. So you're really just bringing us into the transaction, but outside of that, it's a purchase just as you would expect it to be. So on our forms, Matt's going to let us know the closing agent that he's working with, so the title company or the closing attorney. He's also going to let us know if there's a real estate agent involved and any other information that we need to know. So if he's using a loan, for example, who the lender might be, but those forms are going to really outline all of that information for us so that now we can start reaching out and talk to the title company and say, hey, this all has to be vested in the name of Matt's IRA. It's not going to him personally. Once the forms are ready, please send us a copy so that we can make sure everything is titled properly in the name of the IRA. And once we have all of that, we're going to have Matt review it as well, again, to read and approve it and give us permission to send the funds from his IRA to make the purchase. And on the day of closing, we are going to do just that. Again, it's going to be Advanta IRA for benefit of Matt's IRA number 1234. If Matt decides to leave his name off, he can do that as well, and we'll just use his account number as reference. And then once that is done, we actually hold the deed and copy of any documents at Advanta IRA for safekeeping and for our records. And then from there, anytime there is expenses going forward, we will pay them on behalf of the IRA and we will receive any income. And so at this point, let's say Matt purchases this property and he decides, before I put a tenant in place, it needs some fresh paint and some new carpet. Again, Matt is going to determine all of the things he feels are necessary to get it rent ready. Advanta is really not involved in that part of the process. And so if he says, okay, I'm going to hire Joe to come in and do all the painting and replace the carpet, and it's going to cost $5,000, then he's going to either submit a request on our online portal, and he can do that up to $5,000, or he can reach out to his account manager and say, hey, I need a check for Joe for the repairs that he's doing to my new rental property, and we will submit that check directly to Joe for his work, or we can send it to Matt so that he can meet Joe on site and confirm that the work is done to his satisfaction before handing the check over to Joe. What we're not going to do is have Matt write the check and reimburse him. And we also want to make sure that we are writing the check per Matt's instructions. And so again, if he wants us to mail him the check or he can pick it up at one of our offices, we will do that. And then he can always give that check to Joe. But again, no reimbursements here. It has to be directly from the IRA. Sometimes people will say, well, it's just a quote of work being done. How will you handle that? And, you know, if you feel that the quote is going to be the least amount it's going to cost, and you know, depending on what your handyman or your contractor gets involved in, it could cost a little more. We can always write a check for the amount you tell us to, and we can always add another check when the work is completed. So that's no problem, and we're not charging you for check writing, so there's an advantage to you there as well. And then the next thing is Matt is going to rent out the property. He's going to approve the tenant, and he's going to get the lease put together. But ultimately, the lease will be between him, his IRA and the tenant. And so Matt is going to again read and approve the lease. He'll send it to us. We'll sign it on behalf of the IRA, and again keep it for our records. Then when his tenant is ready to pay rent, they can either send it directly to the IRA, or they can send the check to Matt, or he can collect the rent, but the check must be made payable to the IRA. Matt does not want to take personal receipt of any funds. He can pick up the check and forward it on to Advanta so that he can mark in his ledger that the rent was paid on time, but ultimately it will be deposited directly to his retirement account. And he'll see on his statement that it was deposited as rent to 123 Main Street or whatever the address might be. So in this example, the property is going to rent for $1,200 a month, and again, rents are deposited to the IRA. Expenses, including insurance, taxes, and maintenance, are going to be paid by Advanta IRA, and here we're averaging that at about $400 a month. So Matt has determined that this is what the expense is going to come to for this property. And then 2 years later, he has an offer, and I often hear investors tell me everything's for sale. So somebody offers Matt the right price, he's ready to sell. And in this example, he returns $59,200 to his retirement account in 2 years. And so this is a great example of Matt putting his knowledge to work. And he got $19,200 in rental income over those 2 years, plus the $40,000 in profits on the sale. And that is all going to go back to the IRA, tax deferred or tax free. So there's no gains paid on this investment. The money is going to be returned. And now Matt is ready to make the next investment. And at the bottom of the slide here, I do mention checkbook control, and I think I mentioned it a little bit earlier as well. And again, we have a webinar where we talk specifically about checkbook control, but just to really quickly touch on it, if you want to have checkbook control, so Matt literally writing the checks for expenses and depositing income, he can use an LLC. Sometimes personal property trusts are used as well, but we see LLCs much more often. And so how does that work? Well, the IRA is the single member of this LLC. And in that case, the IRA owner acts as manager, and as manager creates the LLC and opens the bank account. The IRA contributes the cash to the LLC's bank account, and now Matt is ready to go as far as writing checks for expenses and receiving income. And that LLC can own any number of properties, and Matt can make those investments. And it's just important to note here, though, that at this point in the strategy, Matt is going to be responsible for the record keeping of that LLC. So, if you're not comfortable with that, it's, it's a big part of what comes along with checkbook control. So from there, Matt is going to receive the income, pay the expenses, and make investments. And on an annual basis, he's going to come back to Advanta and say, this is what the value of my LLC is, so that we can do his IRS reporting. And one thing that I always like to mention here is that you do not have to include IRA in the name of your LLC. As a matter of fact, we prefer that you don't. So you can name it Sunshine LLC or Future Retirement LLC or something like that, but it's going to be up to you. And we've had some very interesting LLCs making investments on behalf of IRAs over the years.
All right, next case study we're going to go and talk about is joint venturing. It's another way, again, you can invest in real estate. The first example focused, kind of very simple investment. Matt just investing in his own rental property. But case study 2, we're going to introduce a couple of people to a particular transaction and how the IRA can be involved. And so the joint venturing on a rehab involves Stephanie and Brett. And Stephanie is the one with the money in her IRA. Brett is the one who's got the project that needs funding. So they meet at a local real estate investor group. So he's looking to flip a house. She's got the cash. How can this work? Again, it's important to note in any investment you make in a self-directed IRA, in this case, it's Stephanie's account. She's doing her due diligence on Brett, the property he's looking to flip, looking at his background, running a credit check, etc., just so she knows who she's getting involved with as far as this particular investment. He's going to use some of his own funds. So Stephanie's got her IRA has cash. Brett has some cash. Brett also has the know-how to rehab the property. So when they discuss in the deal, Stephanie agrees to loan Brett the remaining amount of funds he needs for the purchase and flip. So she's going to put in her cash to help him get that project completed. And they intend, once this deal is done, so the property's been purchased, rehabbed, and sold, that any profits will simply be split 50-50 between them. So kind of a true joint venture on this particular investment. In this particular structure, they decide it's easier for them to form an LLC to buy the property. So we talked about Larissa talked about the checkbook LLC. This is a situation where they're going to form an LLC with 2 members, Brett and Stephanie's IRA account. Stephanie's going to contribute her $100,000 into the LLC's bank account in exchange for that 50% interest. And Brett's going to contribute some of his cash, but also provide his services in exchange for a 50% interest. So Brett may be doing some of the actual physical work on the property again, or he's the one out there choosing the contractors and the work to be done. Stephanie is simply kind of that truly limited partner. Now within the LLC structure itself, Brett is listed as the manager, and the operating agreement for the LLC, which is similar to the bylaws of a corporation, the operating agreement lists Brett as an individual 50% owner, and then Stephanie's IRA, again, seeing that same wording there, Advanta IRA, for benefit of Stephanie's IRA, that's going to show in the operating agreement that she's a 50% owner as well. So they will deposit their cash into that LLC bank account, and then Brett's going to be responsible for not only getting that bank account set up, but then sending money out of the account for the purchase of the property, which would be done in the name of the LLC. He'll sign the closing documents on behalf of the LLC, any expenses for their contractors, any taxes or insurance that need to be paid. He's paying that out of the LLC account and also keeping the books on that particular structure. So in this particular deal, the purchase price was $100,000, and they had $50,000 of rehab costs and targeted the fact that they could sell that property once rehabbed for $250,000, which would give them then potential profit of $100,000 on that particular real estate deal. So they sold the property for $250,000. When you figure in the $30,000 or so of commissions or closing costs, they ended up netting $70,000 of profits. So taking the sales price minus the purchase price minus the rehab minus the closing costs, they end up with $70,000 to split between them. So Brett gets $35,000 for his work and inside that LLC, and now Stephanie's IRA received that $35,000 back on her $100,000 investment. So she's obviously got more to work with now going forward. So this particular case study was both Brett and Stephanie having a 50% interest. If you are looking to work with someone or their IRA account, or if it's your IRA account that is involved, certainly those percentages can be adjusted potentially when you're doing a joint venture as to what the agreement is between the two parties. In this case, Stephanie and Brett are unrelated to each other, so they can have a negotiation as to what type of an arrangement they're going to have when it comes to the profit split on this particular investment. Certainly, Stephanie could have lent him money on a note or mortgage and secured her interest that way, but in this particular case study, she decided to be a joint partner and joint owner right alongside Brett and then share in those profits.
So next we're going to talk about multifamily syndications. And, I like to talk about this just very simply because there's a couple ways to look at a syndication. So of course, one being that if you don't necessarily want to invest directly in real estate and have to worry about tenants, toilets, and termites, as they say, then you can always invest into somebody else's deal and let them handle the tenants and the rehab and all the things that come along with it. And so multifamily syndications is a great way to go. The other way to look at it as well is that if you are raising capital for making investments into apartment complexes and mobile homes, knowing about self-directed IRAs can be a very important tool in your toolbox. So let's look at how that works, and then we'll take a few more questions as well. But Jane and John's deal. So John has $100,000 in an IRA with Vanguard, and he meets Jane, who has a private offering to purchase and remodel an apartment complex. Jane is going to provide John with the subscription documents and prospectus. And again, it's going to be up to John to make sure that he does his due diligence. So he's going to look at the current offering, find out about previous offerings that Jane had, look at the property. Is it valued or worth what she says that it is? Understand the investment that he's making before he goes forward. And then once he's ready, he'll open his account with Advanta. He'll read and approve all the documents and again, complete that purchase authorization form to make the investment. And once we have his approval and the information we need in order to send out the funds, we're going to do that and send the funds to Jane's offering from his IRA account. So again, the investment will be completely in the name of John's IRA. So that's very important. It's going to show the IRA as the limited partner, which is typically what we'll see, general partners and limited partners involved here. And then John's Advanta IRA account manager will really be walking him through this process. And so you don't necessarily have to have made these types of investments before, because we do them all the time. And so we're going to tell you, okay, what we need is the packet for the offering from the investment provider or sponsor, as they're typically called. And then we'll say, okay, we need to see, a lot of times the paperwork comes over to us filled out in the personal name of the investor, and we help them get it changed over to the IRA. The tax ID is Advanta's trust tax ID number, not John's personal social. So again, we want to make sure that it's reported properly for tax purposes going forward. And so that's sort of what we're going to help John do. And then in this example, Jane pays 8% preferred distributions to all subscribers. So $8,000 to John's IRA each year. And then in year 5, the project is refinanced, and John's IRA also receives a lump sum of $30,000 as a final payout. And so typically what happens in syndications is that there is some preferred return, and then there's also a share of the upside. So when that refinance happens, all the limited partners involved will get some percentage of the profits in that deal. And that's typically what you'll see for those. So John's IRA in this example has earned $40,000 in a yearly preferred distribution, plus the $30,000 profit at the end. So he did really well here in this investment. So if you guys have questions on that, just let us know. But again, it's really important to note that you can use this not only for your own investing, but also if you're syndicating and if you're putting a private offering out there, knowing about self-directed IRA accounts can be a huge plus to you. And the only other thing I want to mention very quickly here is that UBIT may apply. So if you're thinking about making these investments, or if you want to learn more so that you can offer the opportunity for your investors to use their retirement funds to make these investments, reach out to either Scott or myself and we can talk to you about how that works and where that may apply. One of the biggest questions we get all the time is, well, this is all well and good, but how do we find these deals? How do we make these investments if we're new to investing? And so what Scott and I would tell you is that you have to network. You have to get in front of like-minded people. And of course, that seems just so much harder these days with everything going on in the world. But, I myself have found that, we have adopted well in society that now there are Zoom calls nationwide. And so where I was attending local events before, I am now a part of groups nationwide, and it has been a lot of fun and very great experience for me. And so that's the first thing that I would tell you. So go to Meetup, search for local groups, and you're going to find that many of them are online now, which is awesome. And then we also have our own networking opportunity as well. So we put it on here, and I think we also have a slide on it coming up, but join us for our Pitch, Promote, and Prosper networking event. We have it every other Friday. So the next one is going to be September 11th. It's at noon Eastern Daylight Time. So 12 o'clock, join us for Pitch, Promote, and Prosper. And what we do is it's a haves and wants style meeting. So if you're not familiar with that, basically what we do is give everybody that wants to speak the opportunity to talk about either what they're looking for or what they have, opportunities to invest with them, or opportunities they're looking for, as well as pitch any services that they provide, and you can provide your contact information as well. And then we also throw out some topic for discussion to the group. So we've had a lot of fun with these. People are joining nationwide, and we have had some really great success with them. We've had people come back and tell us, I made some good connections today. I found the lender I was looking for. I got the information to the question that I needed. And also we've had up to 100 people online with us. So it's been really great, really successful. And so we would encourage everybody to join us.
Yeah, again, that's a great live event for someone who's looking to maybe be a little more active, and then someone maybe who's closer to being ready to go, or someone who learn and find out more. If you'd like to stick with something a little more passive, like the webinar we're on today, we still do and continue to do a lot of events. I mentioned at the very beginning that our commitments for our clients are to, number one, the customer service, but then also to the education that we provide. So we still are doing weekly webinars, sometimes 2 a week on different topics. We bring in a lot of guest speakers as well. I'm not always just talking about self-directed IRAs, but on issues related to self-directed IRAs. We've had people investing who do multifamily syndications. We have people who can tell you whether you should rent or rehab a house, or if you're looking to lend money. And so really make sure you attend some of our events. If you can never make an event live, you can always go back the next day or the day after and watch it on our video library. We have an Advanta IRA on demand YouTube channel where all of our recorded events, including this one today, are archived for you to go back and listen at your convenience. So you can go back and read through those and get educated. And we make getting started really easy. It's a matter of simply opening up your account. Filling out our application takes 10-15 minutes tops. And then we'll pair you again with your account manager, who is going to guide you every step of the way for whatever investment you're looking to make. The second step is funding the account. This is something we also help you out with up front, either transferring money from another IRA or doing a direct rollover from that previous employer plan. And then step 3, once your account is set up, once you have the funds, you're ready to start investing, going out there to find the investment, whether it's one of the types that we talked about today or something different. We'll then begin helping you immediately to get that investment made. And ironically, a lot of people come to us already with step 3. They found the investment they're looking to make. They haven't closed on it yet. They haven't actually consummated the deal yet, but they're looking to make a specific investment. But they decided after analyzing the investment and the deal that they'd like to do that through their IRA account instead, so they come back to us after the fact to get the account open and funded so that we can make that investment for them. As long as you have not closed on a property or finished and finalized the transaction, your IRA could potentially still make that particular investment. So I know we're a little over time, but we have a couple of questions. If people want to stay on, we'll go through some of those questions now and get those answered. Someone asked, do we partner with any non-recourse lenders, or do you have to find your own? We can certainly provide you with a few non-recourse lenders that our clients have worked with over the years. There's North American Savings Bank, NASB.com is one of the bigger ones out there, and there's also First Western Federal Savings Bank based in North or South Dakota. Both of those banks will do non-recourse loans for 2 IRAs in their regular course of business. So again, even though we don't see it very often, a lot of the deals we see are cash deals. If you are looking for a non-recourse loan, either NASB, North American Savings Bank, or First Western Federal Savings would be able to help you out. Another question, are the docs that you store accessible online? So our primary function really for our IRA accounts, again, is as an administrator and record keeper. So we do store all of the documents. We keep records of every single document signed or submitted to us. At this time, they're not accessible for you to view them simply through our online portal. That's something that may certainly come down the road, but certainly at any point, if you need a copy of the documents from a transaction, you simply can call up your account manager, ask them, and we'll make sure we get those over to you. Larissa, since you were talking about the disqualified people and the disqualified individuals, very interesting question here. I live with someone, we're not married, is she a disqualified person?
So this is a tough one, and we get asked this all the time. So although not expressly prohibited, what I would caution you on here, and I do feel like you could ask any number of people and you're going to get sort of mixed reviews, if you will, on this question, because it is a super gray area. At some point or another, I do feel like there's going to be a current benefit for making this investment. And so most of the time, it's going to be prohibited. If you're thinking about doing a transaction like this, I definitely would get an attorney involved that can advise you on the investment. It seems like a little bit of money, but I usually would say, and have heard my partner Alex say often, that it's a little bit of money for a good insurance policy down the line. So if you're thinking about these types of transactions, I would definitely consult an attorney that's familiar with ERISA law, because it is a super gray area. And it would depend on the transaction, but it would just be very difficult not to pick out a current benefit to the IRA holder that would ultimately make this disqualified. And also, another important note here, that if that person is listed as your primary beneficiary, they are automatically disqualified. So again, it's probably going to end up being disqualified, but you can always give us a call and run it by us, and we can tell you, okay, this is where we could see the potential for it being disqualified.
Yeah, and great question here too. Someone says, can I invest and obtain a 5% ownership stake with my IRA in an LLC, and the LLC master leases a property on short-term rentals, and the LLC is going to distribute income from the cash flow from the different guests back to the owners. Again, if your IRA is investing into that LLC and your IRA is obtaining a 5% ownership stake, so your IRA would then be entitled to 5% of the cash flow that's being generated. Now, one caveat to this investment, so it sounds again like something that would not be an issue as long as the IRA is receiving its 5% of profits. If you are a disqualified person or the manager of that LLC or the general partner for that LLC where you're obtaining or basically getting a kind of salary, then that might be in a situation where it's prohibited. But if it's simply a situation where your IRA is going to own a partial stake in an LLC or a corporation, as long as your IRA is receiving back that percentage of income, and that percentage of expenses, and the other people involved are all unrelated, then that's certainly something you can do inside the IRA. It doesn't necessarily matter what the LLC's underlying purpose is. If it's obtaining a property or if it's doing master leasing, that was something that should be permissible. Larissa, if you can, for maybe just talk about our fees for a second. So we have 2 questions here. What are the fees for an account management or for a rental property, and really how we structure our fees?
Absolutely. So that's a great question. Since we're not selling you investments, we're not earning a commission. So we are just simply fee based. You have some startup costs and then you have an annual fee as well. And the annual fee can either be associated with the asset itself. So it could be $295 a year per asset, or you can go based on the value. And typically we're going to see people going with the first option where you definitely have, this 295 fee associated with the asset because it typically makes the most sense. So if you buy a rental property, you're going to have a $145 closing fee. That's what we charge at the time of closing. And then $295 annually means that for that fee, $295, we will pay the expenses, receive the income, and do your IRS reporting. So it's very reasonable, and that fee is regardless of the value. And so your rental property could be purchased at 150,000 and grow to a value of $1 million, and you're just paying $295 annually for that. Now, again, if you're making multiple investments, or if you're starting out with something simple as a contribution to the account, the other option based on value might make more sense for you. And we can always discuss that. If you guys have more questions, reach out to us directly. And Scott has provided our contact information on the screen here again as well. So again, I think we've pretty much covered everything here. So we're going to go ahead and sign off now, but just remember that you will get a copy of the presentation in case you want to either share it or review it again. And I think we'll be able to send the slides, or you may have to request the slides. I can't remember how that works, but we will check in with our marketing team for that. And we appreciate everybody signing on today. Thank you.
Yep. Thanks again, everybody, for showing up, and hopefully you can join us for events in the future.